The resurgence of protectionist trade policies under President Trump's administration marks the most significant departure from economic consensus since Herbert Hoover's ill-fated Smoot-Hawley Tariff. Despite overwhelming expert opinion against such measures, the administration has pursued tariffs based on several questionable premises: stagnant wages over 5 decades, manufacturing decline due to imports, and the notion that trade surplus countries are taking advantage of America. Using executive authority that many constitutional scholars question, President Trump has undermined international trade frameworks and jeopardized global supply chains that took decades to build. Market volatility has increased as investors anticipate the potential economic damage. If these policies continue, economists warn of a possible worldwide recession. Even if manufacturing jobs return, the American economy would become less efficient, growth would diminish, and most citizens would be financially worse off. The fundamental logic behind this protectionist approach defies basic economic principles. The administration claims America can prosper by domestically producing goods that could be purchased more affordably from other countries. Yet, throughout his first term, evidence contradicted this theory. Industrial production initially rose due to deregulation and tax cuts in 2017-18, but fell by 2% in 2019 as protectionist policies took hold. Economic growth, which reached a 13-year peak in 2018, subsequently declined, while manufacturing employment continued its long-term proportional decline despite tariff protections. Proponents of tariffs often point to America's 19th century industrial growth during periods of high tariffs. However, economic historians have consistently shown that U.S. industrialization accelerated when tariff rates decreased. Even President William McKinley, whose 1890 tariff proved both economically and politically disastrous, eventually acknowledged that the period of exclusiveness is past and commercial wars are unprofitable. The first Trump administration's tariff experiments provide clear data on their economic impact. When tariffs were imposed on washing machines in 2018, consumers paid an additional $1.5 billion annually, while customs revenue increased by just $82 million. This translates to an extraordinary cost of $815,000 per job created, 19 times the average salary of appliance manufacturing workers. Similarly, steel tariffs cost consumers $5.6 billion, while creating jobs at approximately $650,000 each, 10 times more than the average steel worker earns. According to Cato Institute research, the pattern is consistent throughout American history. From 1950 to 1990, each job saved or created through tariffs cost consumers approximately $810,000 annually in today's dollars. The administration's singular focus on manufacturing overlooks America's substantial service sector surplus, where wages now exceed those in manufacturing. With 43% of manufacturers already reporting difficulty filling existing positions, where would workers for new manufacturing jobs come from? For 6 decades, Americans have prepared their children for careers in service industries, offering higher wages and greater opportunities. Manufacturing now employs just 8% of American workers, but produces 2.5 times the output value it did in 1975 when it represented 22% of the workforce. The highly mechanized nature of modern manufacturing raises important questions. Would Americans actually want the labor-intensive factory jobs that tariffs might bring back? Should capital for new textile mills come at the expense of investments in artificial intelligence and other emerging technologies? The state-directed capitalism, represented by both current subsidy programs and tariff policies, may attract certain investments and create protected jobs requiring perpetual support, but ultimately misallocates resources and reduces national wealth. Protectionism increases consumer prices, stifles competition, and inhibits innovation and growth. A less efficient economy with reduced growth prospects and restricted markets becomes less attractive to foreign investment over time.